2008, the year the housing market collapsed, leaving families homeless and the global economy in turmoil. The images of foreclosure signs and shattered dreams are unforgettable. Now, in 2025, experts warn of familiar patterns emerging. Are we on the verge of another crash? The stakes are high, but panic isn't the answer, knowledge is. By understanding the warning signs, we can protect ourselves from disaster. It's 2025, home prices are sky high, mortgage rates have spiked, and homeownership feels out of reach. The whispers of a housing bubble are now loud warnings from economists. Loose lending, speculation, and an overheated market echo 2008. Safeguards exist, but many risky ingredients remain. This isn't just about numbers, it's about real people struggling to keep homes. The alarms are sounding. We must learn from the past and act now. This isn't fear-mongering, it's reality. The housing market is in a precarious position, and ignoring the signs will only worsen the fallout. It's time to educate ourselves and make responsible decisions. Whether you own, rent, or hope to buy, understanding the market is crucial. The clock is ticking, the time to act is now. To grasp today's risks, look back to 2008. Irresponsible lending, rampant speculation, and risky subprime loans fueled a bubble. Banks handed out mortgages to almost anyone, and homebuyers chased quick profits. Wall Street packaged risky loans into mortgage-backed securities, selling them worldwide. As long as prices rose, everyone profited. But the foundation was shaky and doomed to collapse. Cracks appeared in late 2006 as home prices stalled and fell. Borrowers owed more than their homes were worth, leading to defaults and foreclosures. Mortgage-backed securities plummeted, banks became insolvent, and credit froze. Millions lost homes, unemployment soared, and the stock market crashed. The 2008 crisis was a global earthquake, plunging the world into recession. The scars of 2008 remind us of the dangers of unchecked speculation and systemic failure. The crisis exposed the fragility of the global financial system and its human cost. Reforms followed: stricter lending, tighter regulations, and stress tests for banks. But have we truly learned? Rising prices, loose lending, and speculation are back. As we face 2025, vigilance and responsible decisions are crucial. Fast forward to 2025, the market is overheating again. Prices have soared, echoing the pre-crash frenzy of 2008. Low rates, stimulus, and pandemic-driven demand have fueled unsustainable growth. Bidding wars and FOMO push prices higher, leaving many behind. Despite stricter rules, the underlying risks are eerily familiar. Experts warn, a painful correction could be coming. The core issue now is affordability. Home prices have outpaced wages, making ownership unattainable for many. The American dream is slipping away, especially for first-time and low-income buyers. This affordability crisis threatens market stability. The longer it persists, the greater the risk of a sharp correction with ripple effects across the economy. Concern isn't limited to online pundits. Top economists and institutions are warning of trouble. The IMF and major banks urge action: raise rates, tighten lending, and boost affordable housing. They're watching key indicators for signs of a downturn. Even the Federal Reserve admits the market is frothy and may act soon to cool it. The Housing Affordability Index has plunged to historic lows. In many cities, families spend over half their income on housing, an unsustainable strain. This disconnect between prices and incomes is a clear warning. If it continues, defaults and foreclosures could rise, triggering a market correction. Mortgage delinquencies are rising as pandemic safety nets expire. Higher rates and inflation are squeezing homeowners, especially those with risky loans. Delinquencies signal growing financial fragility. If this trend continues, a wave of foreclosures could depress home values and trigger a broader downturn. The third red flag signaling potential trouble in the housing market isn't found in economic indicators or financial reports, but actually in the actions of those on the front lines of the industry, real estate companies themselves. In recent months, there's been a noticeable uptick in layoffs and hiring freezes across the real estate sector, from major brokerage firms to online real estate platforms. These companies, which are highly sensitive to shifts in the housing market, are often the first to feel the pinch when activity slows down or when they anticipate a downturn. Layoffs and hiring freezes are really just cost-cutting measures, a way for these companies to brace themselves for a potential decline in revenue as the housing market cools. While these layoffs might seem isolated at first glance, they actually represent a broader trend of retrenchment within the real estate industry. Companies are becoming more cautious, tightening their belts and preparing for a potential slowdown in sales and a decline in home prices. This insider perspective honestly is often more telling than any economic indicator, and suggests that those closest to the housing market are sensing a shift in the winds. When real estate companies whose fortunes are directly tied to the health of the housing market start battening down the hatches, it's a clear sign that storm clouds may be gathering on the horizon. This insider signal, combined with other red flags, paints a pretty concerning picture for the future of the 2025 housing market. The fourth red flag signaling a potential housing market correction is a familiar villain from the 2008 crisis: tightening credit conditions. Banks, which were once eager to lend to homebuyers, are now becoming increasingly risk-averse, raising lending standards, and pulling back on mortgage approvals. This credit crunch, while often overlooked, is actually a significant headwind for the housing market because it directly impacts the ability of buyers to secure financing and complete transactions. There are several factors driving this credit tightening. First, rising interest rates make mortgages more expensive, which reduces the pool of qualified borrowers and makes banks more cautious about lending. Second, those increasing delinquency rates we talked about earlier have made banks more wary of potential defaults, so they're really scrutinizing loan applications more closely and requiring larger down payments. Third, the uncertain economic outlook, fueled by inflation, geopolitical instability, and fears of a recession, has made banks more risk-averse in general, leading them to tighten lending standards across the board, including for mortgages. This credit crunch, while intended to mitigate risk for banks, has the unintended consequence of cooling down the housing market. When banks become reluctant to lend, it creates a ripple effect throughout the housing market. Buyers, unable to secure financing, are forced to delay or even abandon their home searches, which reduces demand and puts downward pressure on prices. This credit crunch, which is a clear departure from the loose lending practices that fueled the 2008 bubble, is a significant red flag that suggests the housing market is, well, losing steam. So the fifth and final red flag pointing towards a potential housing market correction might actually seem a bit counterintuitive at first glance: a tightening rental market. You might think that a cooling housing market would lead to a loosening rental market, as more folks decide to rent instead of buy. But honestly, the opposite is happening in a lot of places, with rental vacancies dropping fast and rents just shooting up. This kind of paradoxical situation is being driven by a few different factors. First off, all those affordability challenges we talked about earlier are pushing a lot of would-be homebuyers out of the market, so they're sticking with renting longer than they planned, and that's just driving up demand for rentals. Then, with interest rates rising, it's gotten less appealing for homeowners to sell and move, so some are turning their homes into rentals instead, which actually reduces the number of available rental units even more. On top of that, there's this influx of new residents to many cities, people drawn by job opportunities or just looking for a more urban lifestyle. That's putting even more pressure on the rental market, leading to bidding wars for apartments and rents climbing even higher. So, this tightening rental market, even though it might seem separate from the housing market, is actually just another symptom of the same issues: affordability problems, higher interest rates, and not enough housing options. And honestly, a tight rental market where vacancies are low and rents are high puts extra pressure on household budgets. That leaves people with less money to save for a down payment or to qualify for a mortgage, which in turn weakens demand for homes and could help cool down the housing market even more. The air right now is thick with a familiar unease. It's the year 2025, and the warning signs are flashing red. Home prices have reached dizzying heights, and for a lot of folks, affordability is just a distant dream. Experts are even starting to whisper that dreaded B word, bubble. The parallels to 2008, a year that's really burned into our memories as a time of financial devastation, are honestly hard to ignore and, well, pretty unsettling. Just like in the years before the 2008 crash, it feels like the housing market is operating in a world that's totally detached from economic fundamentals. Prices have soared way past what the average person can afford, fueled by this mix of low interest rates, speculative frenzy, and that classic fear of missing out. The idea of easy money, of buying low and selling high, has pulled in both investors and home buyers, creating a frenzy that's pushed prices to levels that just don't seem sustainable. And, this sense of déjà vu is only getting stronger with the return of risky lending practices. Now, they might not be as widespread or as reckless as the subprime mortgages that blew up in 2008, but there's definitely some concern about the rise of adjustable rate mortgages, low down payment loans, and other exotic mortgage products that could leave borrowers exposed if rates go up or prices drop. So as we stand at this crossroads, the big question on everyone's mind is whether history is about to repeat itself. Will 2025 just be an echo of 2008, or is it going to turn out differently this time? The answer, like with most complicated economic questions, isn't simple. While the similarities to 2008 are pretty striking, it's important to keep in mind that the 2025 housing market isn't just a carbon copy of what happened back then. There are actually some key differences that could soften the blow if there is a downturn. And honestly, that gives us a little hope in all this uncertainty. One major difference is the regulatory landscape. After the 2008 crisis, governments around the world put stricter rules in place for financial institutions, all with the goal of stopping the kind of reckless lending that fueled the last bubble. These regulations aren't perfect, but they have made the financial system more resilient and, hopefully, reduced the chances of a total meltdown. Another big difference is in the underlying economic fundamentals. Unlike in 2008, when the housing bubble was built on shaky ground, mostly subprime mortgages and wild speculation, the 2025 market is at least partly supported by real demand. Years of underbuilding have left us with a shortage of homes, especially in popular urban areas, and that's putting real upward pressure on prices. Plus, the current economic climate, while it's got its own challenges like inflation and supply chain issues, is generally stronger than what we saw before the 2008 crash. Unemployment rates are relatively low, wages are starting to show some growth, and even though consumer confidence has taken a hit, it hasn't completely disappeared. All these things suggest that, if a housing market correction does happen, the economy might actually be in a better position to handle it. So, will history repeat itself? Will the 2025 housing market go down in flames, mirroring the devastation of 2008? Or will it experience a more controlled correction, a period of adjustment rather than a catastrophic collapse? The answer, unfortunately, remains shrouded in uncertainty. Those who believe a crash is imminent point to the alarming parallels to 2008, arguing that the current levels of price appreciation, speculative behavior, and risky lending are just unsustainable and will inevitably lead to a sharp and painful correction. They argue that the regulatory safeguards put in place after the last crisis are insufficient to prevent another meltdown, and that the underlying economic fundamentals are not as strong as they appear. On the other hand, those who anticipate a softer landing, a correction rather than a crash, emphasize the key differences between 2025 and 2008. They highlight the stricter regulations, the stronger economic fundamentals, and the role of genuine demand in driving price appreciation. They argue that while a correction is certainly possible and perhaps even likely, it is unlikely to be as severe or as prolonged as the 2008 crash. The truth likely lies somewhere in between these two extremes. The 2025 housing market is unlikely to experience a repeat of the 2008 meltdown, thanks to the lessons learned and the safeguards put in place. However, a correction, a period of price adjustment and market cooling, is highly probable. The severity of this correction will depend on a multitude of factors, including the pace of interest rate hikes, the resilience of the economy, and the behavior of homebuyers and investors in the face of uncertainty. The dream of homeownership, deeply ingrained in the American psyche, can feel increasingly elusive in the face of a volatile housing market. For those aspiring to own a piece of the American dream, the current climate, marked by high prices, rising interest rates, and whispers of a potential correction, can be pretty daunting. But it's not an impossible dream. With careful planning, a healthy dose of realism, and a focus on long-term financial well-being, you can navigate the housing maze and make smart decisions that align with your goals. The first and most crucial piece of advice is simple: don't panic. The fear of missing out, FOMO as we call it, a powerful psychological force that can lead to impulsive decisions, is really your worst enemy in this market. Remember that the housing market, like all markets, is cyclical. What goes up must eventually come down, and vice versa. Don't let the fear of missing out on the supposed peak lead you to make a decision you might regret later. Second, be realistic about what you can afford. Don't stretch your budget to the breaking point just to get into a house. Remember that owning a home comes with a multitude of expenses beyond the mortgage payment, including property taxes, insurance, maintenance, and potential repairs. Factor in these costs when determining your budget, and make sure you have a comfortable financial cushion to weather any unexpected expenses or economic downturns. Third, be patient and strategic. Don't feel pressured to buy into a market that doesn't feel right for you. Take your time, do your research, and wait for the right opportunity. This might mean expanding your search to different neighborhoods, considering a smaller home than you initially planned, or even renting for a while longer to save up a larger down payment. Remember that buying a home is a long-term investment, not a race to the finish line. For those who already own a home, the current housing market presents, a different set of challenges and opportunities. While rising home values might have boosted your equity on paper, it's important to remember that these gains aren't realized until you actually sell your property. And with the market showing some signs of cooling, it's really crucial to approach your housing situation with a level-headed perspective and a focus on financial prudence. If you're considering selling your home, it's essential to carefully weigh the pros and cons. While you might be able to capitalize on current high prices, just keep in mind that you'll likely be buying into the same market, facing higher interest rates and potentially lower inventory. Before making a decision, take the time to assess your financial situation, your long-term housing needs, and your tolerance for risk. If you're staying put for the foreseeable future, now is a good time to prioritize financial stability. Build up your emergency fund, pay down high-interest debt, and consider refinancing your mortgage to lock in a lower interest rate while you still can. These steps will strengthen your financial foundation and provide a buffer against potential economic headwinds. Additionally, it's crucial to stay informed about the local housing market. Keep an eye on trends like inventory levels, median home prices, and days on market. This information will help you gauge the temperature of the market and make informed decisions about your property. Remember, owning a home is a long-term investment. Don't let short-term market fluctuations dictate your decisions. Focus on your financial well-being, maintain your property, and be prepared to ride out any market storms that may come your way. In the world of finance, knowledge is power. This holds especially true in the often turbulent realm of the housing market. Whether you're a seasoned homeowner, a first-time buyer, or just someone trying to make sense of the headlines, arming yourself with knowledge is honestly the best defense against uncertainty and the key to making informed decisions that protect your financial well-being. Don't rely solely on headlines or social media chatter for your information. While these sources can give you a glimpse into current trends, they often lack the depth and context necessary to make truly informed decisions. Seek out reputable sources of information, such as financial publications, government agencies, and respected economists. Take the time to understand the factors that drive the housing market, like interest rates, inventory levels, economic growth, and government policies. Learn about the different types of mortgages, the risks and rewards of homeownership, and the legal and financial aspects of buying and selling property. And don't be afraid to ask questions. If you're working with a real estate agent, mortgage broker, or financial advisor, don't hesitate to ask for clarification on anything you don't understand. Remember, you're the one making the decisions, and you deserve to have all the information you need to feel confident and, informed. As we stand on the precipice of what could be a defining moment for the housing market, a sense of unease kind of hangs in the air. The echoes of 2008, a year that's become synonymous with financial turmoil and shattered dreams, still reverberate in the back of our minds. The warning signs are undeniable: soaring prices, stretched affordability, whispers of risky lending practices, and a growing chorus of concern from experts. Yet, amidst all this uncertainty, there is a glimmer of hope. The lessons learned from the past have not been in vain. Stricter regulations, a more resilient financial system, and a stronger economic foundation provide a buffer against a complete meltdown. The question isn't if a correction will occur, but when and just how severe it will be. Will this be a period of gentle adjustment, a soft landing that allows the market to recalibrate without wreaking havoc? Or will it be a sharp and painful correction, a stark reminder that even in the face of cautionary tales, the allure of easy money and speculative excess can lead to dangerous imbalances? Only time will tell. But one thing is certain: the choices we make today, both individually and collectively, will shape the future of the housing market and the financial well-being of millions. In these uncertain times, knowledge is honestly our greatest asset. We can't afford to be passive observers, just swept along by the currents of market forces beyond our control. We really need to be active participants, armed with information and empowered to make informed decisions that protect our financial futures. Stay informed about the trends shaping the housing market, both locally and nationally. Pay attention to interest rate movements, inventory levels, affordability indicators, and expert analysis. Don't rely solely on headlines or hearsay. Dig deeper, seek out reputable sources, and form your own conclusions. Whether you're a homeowner, a renter, or a prospective buyer, approach the housing market with a healthy dose of caution and a long-term perspective. Don't let fear or greed dictate your decisions. Be realistic about your financial limitations, prioritize stability over speculation, and remember that owning a home is a marathon, not a sprint. The future of the housing market may be uncertain, but our ability to navigate it wisely is not. By staying informed, remaining vigilant, and making prudent financial decisions, we can weather the storms that may lie ahead and, hopefully, emerge stronger on the other side.